What are your feelings right now regarding Tesla stock? Throughout the past year, one of the most volatile equities on the market has been Tesla. Of course, it should also be remembered that last year was a disaster for the whole its sector. Experts are divided on whether to be bulls or bears right now. When you see this, make sure not to pass it up. The market has now turned. In 2021, Chamath Palihapitiya stated, Tesla will be very busy just being a best-in-class EV company. Chamath Palihapitiya disclosed at the time that he had sold his Tesla stock to raise money for other investing ventures. The CEO and founder of Social Capital stated that he withdrew his investment from the Elon Musk-led electric car startup almost a year ago since the company's high prices enabled him to raise money for his other ventures. When I have these ideas, the money has to come from somewhere because I don't have an endless pool of capital, Palihapitiya stated in January of that year at CNBC's Delivering Alpha conference. When Tesla's stock was selling at about $800, Palihapitiya told CNBC that the company was in the distributed energy space and that the stock might double or even treble in 2020. Due to investors' inclination towards companies with growth potential and the robust demand for electric automobiles, Tesla emerged as one of the stock market's greatest winners. In 2020, the shares had an incredible 743% increase. The following year saw the stock climb 10.7% so far this year, underperforming the overall market. Although Palihapitiya's thesis on Tesla has slightly shifted, he remains bullish on the firm. He acknowledged that he had greatly misjudged the potential size of the EV industry. He says that the market has turned and Tesla will have a lot on its plate just to maintain its position as the finest EV manufacturer. In the San Francisco Bay Area, Chamath Palihapitiya is a highly successful venture capitalist and entrepreneur. He came up at number 10 on Forbes magazine's list of the newest billionaires in 2021. In order to invest in businesses in industries like health, finance, and education that other venture capitalists were passing over, Palihapitiya launched Social Capital in 2011, but since then, the business has grown to include investments in internet firms like Slack, Tesla, and Amazon. Electrification has a clear winner, Palihapitiya declared in a 2019 CNBC interview. That die has been cast, it is done. Can CEO Elon Musk now construct the necessary infrastructure? I think he will, if given the opportunity and patience. Despite the numerous obstacles Tesla had to overcome, Palihapitiya stated that the firm will benefit in the long run by being the first to market with electric vehicles. Palihapitiya contends that too much attention is being paid to Musk's behavior as window dressing and insufficient attention is being paid to Tesla itself and its competitiveness in the market. He contrasted the Zune media device, a doomed Microsoft attempt to compete with Apple's iPod, to rivals of Tesla, such Audi's latest electric offering. He may mistweet from time to time if you get caught up in all this stuff around the edges. Palihapitiya added, referring to Musk's remarks regarding funding and production numbers at Tesla that have landed him in hot water with the Securities and Exchange Commission. I'm saying, who gives a damn? It's your responsibility as a shrewd investor to sort the news as facts from its fantasy and noise. Palihapitiya claimed at the time that he still owned Tesla stock because Musk had a track record of fulfilling commitments on a bigger scale. Years from now, he claimed Musk's actions on Twitter and the podcast won't matter because demand for Tesla vehicles is high and outpaces that of other electric car manufacturers, that other stuff is all irrelevant. The reality that tens of thousands of buyers are purchasing that car more quickly than they can obtain it remains unchanged. It doesn't change the fact that your perception of what is anticipated changes irrevocably the moment you get in the car. Ultimately, Palihapitiya stated of Musk, his substance is irrefutable. Whether you like his style or not, people are placing bets against his approach, against business people who are revolutionizing the global economy. That has never been a successful venture. Elon Musk, the CEO of Tesla, has reportedly stated that there are 4 reasons why the company's price might fall as low as $50, and this includes his endeavor on Twitter. Nevertheless, Tesla's market capitalization surpasses that of its 4 competitors combined, even if its sales amount to just 9% of the $389 billion total of Toyota, GM, Ford, and VW. Nevertheless, some people think that purchasing Tesla stock in 2023 is a no-brainer decision. They claim that the disruptive electric car maker is trading much below its historical peak. Like many other businesses today, Tesla is confronted with substantial short-term hurdles such as rising rates and inflation, which drive up the cost of capital and depress growth stock prices. Investors should also be wary of the actions of Elon Musk, the CEO of the business, who in October paid $44 billion to acquire the social media platform Twitter. Notably, Musk raised money for the acquisition in 2022 by selling a staggering $23 billion worth of Tesla stock. Though short-term stock sales can lower a company's price, fundamentally oriented investors shouldn't be too concerned about this. The selling of current shares has no effect on Tesla's valuation in relation to its earnings or cash flow, in contrast to equity dilution, which involves the creation of new shares. Although some think Musk is using the Twitter acquisition as a diversion, this worry also seems exaggerated. Tesla has made significant progress from the precipitous losses that almost drove the company to insolvency in 2008. The company's ability to maintain profitability and capitalization makes it less dependent on the managerial prowess and perseverance of one individual. Additionally, Tesla is outperforming its competitors in the automobile sector and turning a profit. Q3 2022 saw a 56% increase in total sales to $21.45 billion and a doubling of net income to $3.29 billion. Despite selling 7 times more cars during that time, Tesla's biggest rival, Toyota, only made $3.15 billion according to Nikkei Asia. It is important to remember, though, that Toyota still primarily makes gasoline-powered vehicles. However, Nikkei Asia thinks that Tesla's advantage stems from its powerful brand, which enables it to demand a higher price for its cars. The company's production process is streamlined because to its focused concentration on electric cars, EVs, as opposed to traditional manufacturers that produce a wide range of gasoline-powered, hybrid, and electric vehicles. Some, on the other hand, think that Tesla's business is slowing down in China following a string of price reductions, which the vice president of the company's external relations in China attributes to numerous technical advancements. It's important for investors to keep in mind that the price reductions coincide with a wider decline in the auto sector brought on by high interest rates, inflation, and consumer confidence. However, Tesla's management is still upbeat about the long run and projects an average annual rise in vehicle deliveries of 50% over a period of several years. Renowned value investor Bill Miller disclosed his short position in Tesla at the beginning of January, telling CNBC that he believes it isn't worth more than the aggregate value of the top 5 automakers worldwide. Some contend, however, that Tesla should be valued differently from traditional automakers making the switch to technology because it has enjoyed pure growth in the EV industry, whereas its competitors are cannibalizing their current products with electric alternatives, a move that may ultimately cost them all of the market share. Additionally, Tesla has above-average profits, as evidenced by its 23 projected price-to-earnings multiple. Taking into account its rate of growth, Tesla is no longer an expensive stock by any means. This figure lags below established value stocks such as McDonald's and Coca-Cola, which have forward multiples of 26 and 25, respectively, and is far lower than the NASDAQ average of 25. It's doubtful that the shares will remain this low for very long. Because of this, the stock value of Tesla is beginning to seem reasonable when considering the underlying momentum of the company. Even though it's always possible that growth doesn't work out as planned, especially in the short term when consumers may put off buying a car due to macroeconomic uncertainties, the company's recent success and promising product pipeline create a strong argument for the stock. Owning the infamously volatile stock carries risks, of course, but at this price it might make sense to allocate a modest portion of your portfolio to Tesla shares. When investors take into account the company's 2 main drivers of growth, the anticipated introduction of Tesla's Cybertruck in 2019 and its phenomenal expansion in the energy storage sector, strong growth this year also appears inevitable. In the company's third-quarter earnings call, Tesla management reported that it has reached a production volume of 2,000 cars per week at its new factory in Germany, indicating that the company's vehicle manufacturing is also doing well. This milestone should be reached shortly by its new factory in Texas, according to management. During this time, the company's Fremont, California factory saw unprecedented levels of production. All things considered, the company is doing well. Its balance sheet is supported by $21.1 billion in cash and marketable securities, up $2.2 billion sequentially, and free cash flow of $3.3 billion during Q3, a 148% year-over-year increase. For more, be sure to subscribe to Tesla stock.